Welcome back, everyone. Today on the Joseph Carlson Show, we've had a busy week. Over the past weekend, we have had major conflicts break out in the world, macroeconomic concerns, oil prices changing, lots of attention-grabbing headlines and very concerning things. But regardless of all of that, the market continues upwards, up 1%, defying the expectation of many people that were concerned about this day, Monday. How would the markets open? We know that there's lots of concerns going on. We know that there's lots of trouble in the world. So why do investors remain bullish? Are they just ignorant? Are investors just stupid? Well, I don't think so. I think this is the right move from investors. Investors know what we know and what we don't know. We don't know what macroeconomic concerns will happen in the future. We don't know which wars will break out or how they'll conclude. We don't know a lot of things. In fact, investors don't know most things. But we do know a couple things. We know that the market over time typically goes up, regardless of all the conflicts, all the tensions, regardless of economic problems, recessions, even the Great Recession, bubbles, everything included. The market typically goes up over time. That's something we know. One other thing that investors are becoming increasingly convinced of, that they're starting to know for sure, is that artificial intelligence is the future, and it's here to stay. We're going to highlight an entire episode of artificial intelligence. First, we'll start off by going over 10 different AI companies, whether or not I believe they're buys today, and I'll give you my reasoning behind each one of them. Then we have a recent interview with Brad Gerstner, where he went over a soliloquy, a speech about artificial intelligence. He gave his big thoughts on the companies that are really going to move the needle. I'll be responding to this interview, sharing some thoughts about some specific companies he highlights. We have news that Meta is doubling and tripling down on artificial intelligence. They are trying to become an AI company themselves first and foremost. Not just one that's good at using it, but they want to be an AI company. And this is with an acquisition of a company called Scale AI. Should investors really be celebrating this acquisition? We'll see. And then finally, we have a lawsuit here. Disney and Universal are suing the AI firm Midjourney. Now, Midjourney is that image video creator. In fact, they make a lot of really high-end videos. It's a bit like Google's VO3. And this brings up a lot of questions about the intellectual property of artificial intelligence. Midjourney and other companies are recreating Disney content on the fly in super HD format. It looks real. And they're creating Star Wars and Marvel content. Should these companies be allowed to do this? We'll be discussing in this episode. So like always, we have a ton to get to in this episode, and we'll start things off with the discussion on the top 10 AI companies. Now, the reason that I bring up this question, AI, so continually, is because, well, if we look at a quote from Jeff Bezos, he says that he's often asked about what's going to change in the future. People come to him and they say, how do you see things working out differently in the future? And he says that that's a good question, but a much better question is rather than what's going to change in the future, what's going to stay the same. If you can become confident in not what's going to change, but rather what's going to stay the same in the future, you can put a lot of money and effort towards building things around what's going to stay the same. In the case of Amazon, he realized that things that aren't going to change is people want a wide selection, low prices, and fast shipping. Those three things. So Amazon could confidently build an entire business about three things that they knew would never change. Now, in that same spirit, there's a couple things that I do know won't change in the future. And one of them that I become very confident of is artificial intelligence. It is not going to go away. It's not going to become a smaller part of life. Artificial intelligence is here to stay. And investors that invest accurately or correctly in the right artificial intelligence stand to make a lot of money and outperform the market by a huge degree. And when we look at these artificial intelligence companies, I believe they can be broken down into three separate categories. First, the companies that are creating AI. These are the companies pioneering the field. They have the data scientists, the engineers, the real brains behind the operation that create artificial intelligence, the leading models. They test them and they iterate on better and better models. They are the model companies, the ones like Anthropic or OpenAI. Then we have the companies that don't create the value, but they have huge software. They have applications, they have connections with millions of customers, and they have unique ways where they can take these models, they can license them or plug them into their platform and create enormous value for their companies. There's many companies that fit in this category. They're not directly creating AI, but they are massive beneficiaries of AI. That's the second category. And the third one, I believe, are the companies that do both. They're both creating the AI and they have massive applications and platforms that can benefit from the AI that they're creating. These companies have the best of both worlds. So we have these three different categories: companies creating AI, companies benefiting from AI, and companies doing both of these. And those are the companies that we're going to go over in this list of 10. And we start things off with a discussion on ASML. This is a first and foremost AI company that develops and helps build AI. Now, they're not doing the software aspect of it, they're doing the hardware, but they play a pivotal, key, critical part of the AI development. I like ASML for a lot of reasons. A lot of people say, Joseph, why don't you invest in TSM or talk about TSM? I believe that ASML is a better play than TSM. TSM is a great company, but ASML is even further up on the food chain. It's even more monopolistic. It has even fewer competitors than TSM. That's how incredibly dominant this company is in its given category. So when I look at ASML, I see it as the best of breed in the physical hardware of creating AI. And I believe this company is a buy today for a couple of reasons. Now, first of all, when we look at ASML, I have this one already in the portfolio. So it's not one I'm just talking about as being a buy. I've actually put a lot of money into this one. In the tech category, I have a $51,000 position with currently $4,000 in the green. When we look at companies that we want to be confident in, our AI winners, we want to look at both the valuation and how much they're going to benefit from artificial intelligence. ASML has a direct line of benefit from artificial intelligence. They are behind every single high-end chip that's made. So as AI creates more chip demand, which we've seen with companies like Nvidia, companies like TSM, AI will directly benefit ASML's business. Now, on top of that, we know that this company is very monopolistic. There's other companies trying to create the same thing. Other nations like China are trying to create it, but they are so far years behind. They just don't have the technology. This company continues to iterate at a faster pace as well. So we know that they're far ahead. We have years of massive growth for this company. The revenue continues to go up over time. Look at the revenue over time, growing 17%. The company's free cash flow is very lumpy, but it is guaranteed. These are contracts. They will be paid this money. They're selling their newest machines for $400 million. In the last 12 months, they've made $10 billion in free cash flow. When we look at the valuation over time, this is another chart I try to look at to give me safety. And what do you see here with the price to earnings? Over the past year, the PE ratio has gone down from a 60 trailing to now around a 35. We are at a far safer valuation for this company as the stock price has dropped. If we look at the past 5 years, it's trading near the all-time lows. It doesn't really get much cheaper for this company for ASML. So I believe that we have very low potential downside. I don't think ASML is going to go a lot lower. And if anything, we're going to see more of these bumps, enthusiasm, times where investors get back on board of this company, and it has multiple expansion. But even if it doesn't have multiple expansion, I believe the earnings power will continue to grow. So we don't have to bet on multiple expansion. That's just a bonus. We can just wait for earnings growth. But if we get both multiple expansion and earnings growth, that's where you get incredible returns. ASML is a solid bet on a company creating artificial intelligence, making the necessary hardware, and it's trading at a good valuation. For me, this one's a buy. The next company we'll look at is a big tech company. We have Meta here. Meta so far is a company that's transitioning from one of these AI categories to the other. So far, Meta has been a company that has mostly benefited from artificial intelligence without really creating it. They've simply taken what's already existed, they've applied it generally to their entire application stack, to their advertising, making things run more efficiently. And you've seen the gains, the margin expansion over time, the huge gains in free cash flow. That's from artificial intelligence helping them run more efficient ads. So AI has been a beneficiary of Meta, but they haven't directly created it or sold it. And they're now trying to move into that next camp of being one of the real creators of artificial intelligence that sells it directly. Now, I don't own any Meta stock, but I still consider it today a reasonably priced company. I would call it a soft buy, not a strong buy. I think it's transitioning valuation-wise into that territory of being at a little bit higher of a valuation. Investors today likely aren't getting the best deal on the company, but I still believe it has a really good future. And we'll be talking more about Meta in the upcoming news section. The next one's Amazon, and this one fits firmly in category 3. I believe Amazon is one of the best positioned artificial intelligence companies in the world today, and I believe it has been for a number of years. I sound like a broken record talking about how Amazon's an AI company. In many ways, it's a forgotten AI company. We had people like Brad Gerstner or Gene Munster talk about how Amazon really didn't have much of an AI play, is how they called it, because they didn't have their own model at the time. But Amazon has extremely wide and scaling applications for potential use for artificial intelligence, one of them being in robotics. Look at the scale of Amazon. If we look at this company, it's now trading at $215. If we look at the revenue over the trailing 12 months, they generate $650 billion in revenue. Most of that comes from first and third party sales. So that tan part and the orange part, making up over 50% of their revenue, that's the selling part. Amazon's benefiting from AI in a lot of different things like logistics, planning, lots of search demand, predictive technology, all of that type of software thinking stuff. But it also has huge applications and potential future applications in robotics. Amazon knows robots really well. They have over 750,000 of them in their warehouses, but they're typically single use. Like the robots are really good at doing one type of task. Now, that's really good, but we're getting to the point of humanoid robots, ones that are multitask. They can do lots of different various things like a human. These companies know how to do the physical technology, all the hydraulics, the structure, the actuators, all those different things. The real question for them is the software, the knowledge, the brain of the robot. And that's a problem that artificial intelligence is really good at. So Amazon's in a category where they have very powerful AI models, but they also have a massive retail business and logistics network and delivery network that can benefit directly from implementing AI into robotics. They've already been seen, or at least there's rumors, that they're testing robots that will jump out of the back of a van and take a package from the van to the doorstep. Might sound small, but when they're doing that 1 billion times a day, that adds up. The margins that this could save is massive. So Amazon is a company that has virtually infinite applications of artificial intelligence while owning their own model. In my opinion, this is the top tier category to be in. It is the best positioned AI company to be in. And I think that a lot of investors that are focused on just the companies creating AI or just the ones that are applying them are missing the companies that are doing both. Amazon is both creating it and applying it, and they have far more applications than other companies. I think this one's going to be a massive winner. I've been saying this since Amazon was 170. Now it's back up to 215. It'll get to 220. It's going to go to 240. It's going to go to 260. You'll see this happen over time, as there's literally no company that has more operating leverage. It is incredible to see the margin expansion potential of this company and the way that AI is going to affect it. It's already been a winning stock so far, but we have a lot more to go with this one. Now, next up, we have Intuit. This is another company I want to highlight again, and it's one that I feel like I'm the only one talking about this company. Is there anyone else even ever talking about Intuit? It's such an incredible company. It has such a dominant moat. It is an AI company, and it's doing incredibly well. It's one of the best companies in the market today. In fact, Intuit's up 24% year to date, pays a dividend. In the past year, it's up 27%. The past 5 years, it's up 170. But they have a few huge properties, including TurboTax. They have Credit Karma, which is growing incredibly fast. That's more of an affiliate referral website. It also tracks your credit score for free. And of course, they have QuickBooks, which has huge market share with small business tax and accounting. These aren't necessarily all subscription-based, but they basically are. You have to do your taxes every year. Small businesses have to do their accounting. These aren't optional things. They are mission critical, and Intuit's behind all of it. Now, Intuit's also been in a unique position to implement AI into all of their software. Intuit's not creating any groundbreaking AI generic models. They're not licensing out their models for other companies to use. So they're not one of the companies like ASML or OpenAI that's creating AI. They are firmly in the camp of benefiting from artificial intelligence, and it's shown up in the numbers. Let me show you some numbers here that prove Intuit is benefiting directly from artificial intelligence. One of them is revenue growth. Revenue growth has accelerated. Let's take a look at it. In the past 10 years, you'll notice that they're growing at a pretty consistent rate throughout 2022. And then the growth rate actually ticked up from around 12% to 15%. The free cash flow is also growing really fast. In the past 10 years, it's averaged a growth rate. The compound annual growth rate is 16%. So that's the past decade, but in the past 1 year, it's 20.5%. An acceleration in free cash flow. And while they're increasing the growth of their revenue, they're increasing the growth of their free cash flow, their margins are moving up, the employee count is also slowing down. meaning that they're being disciplined with their hiring. They're being more efficient with the employees they have. This is an AI winner that I'd put on the watch list, wait for a big dip in the stock, and buy when the opportunity presents. Next up, we got the company that's become the hardware face of AI, which is Nvidia. Nvidia is now at 145, and it's traded around this time period for around a year. If we look back over the past 1 year, yeah, it's up around 11%. So not much of a move for a company this volatile. You can see that it's basically been trading around this range, but Nvidia has proven to investors during this time period that it's been worth it. The stock has been a little bit more stable with its revenue. It continues to grow as investors expect. It's not a company that's going above and beyond investors' expectations nearly as much as it was a year ago. And that's why we're not seeing the big moves up anymore. But I become more convinced that Nvidia is in a better spot and more of a safe company than I thought a year ago. A year ago, I was a bit more concerned about it. But over the past year, I've become more convinced that AI is here to stay. There's going to be continued massive CapEx demand for this company. So I'm moving Nvidia right now into a category of a buy. I think that investors will do quite well. Now, I don't think it's going to have the astronomical performance it had a couple years ago, but I think you can view Nvidia as a strong compounding machine in the hardware category. Given the choice between Nvidia or TSM or ASML, I've made my bet, and it's with ASML. I believe ASML has plenty of upside, and it's a bit more insulated from competition than Nvidia. Either way, I view this one as a buy today. The next AI company we have is Salesforce, which a lot of people debate whether or not it's really an AI company, because they're not directly creating the models like a lot of these companies, but they are benefiting from artificial intelligence, and they have massive application for AI. So when I look at Salesforce, I'll give the little caveat here that this is my worst performing holding. So out of my entire portfolio, this one's the worst. Let's go ahead and take a look at it. I believe it's the only one I'm in the red on. That's right. Right now it's in the red by around $3,000. It's been swinging back and forth from the red to the green over the past year that I've owned this thing. So it hasn't been a great holding so far. But what I do in these situations is I don't let the trading action or the price dictate my sentiment on the stock. And you can see that this is what happens with all of these companies. If Salesforce was up to $350, investors would be talking about how it's a great investment, how it's an AI company that's really doing a great job with Agentforce and all the technology. But as soon as Salesforce drops down to $270, investors toss it out. They act like it's a bad company, like Mark Benioff is not doing a great job. You can see for the huge majority of investors, the price that Salesforce trades at directly affects their sentiment on the stock, how they view the company. As investors, we can't allow that to happen. We have to look independently with clear eyes at the company and look at what they're doing, the valuation, the products they have, and come to our own conclusions. When I look at Salesforce, I continually come to the conclusion that this company is in a way better position than what the market is bidding it at. Right now, the company's trading at $260. It's trading down. In fact, year to date, it's down nearly 21%. So what has Salesforce done deserving of this big sell-off? When we look at it, it's also not just trading down because it was overvalued previously. So it wasn't trading at some astronomical valuation. It's at a $250 billion market cap. It's at a 22 forward PE ratio. The free cash flow yield, even adjusting out stock-based comp, is 4.07%. If we look over time on the valuation and look at how this is stacked up against its history, we can see that over the past year, it's towards the very bottom. Almost the very bottom that it's been. There's only one other time it's been cheaper. This is on a price to earnings. When we switch to a free cash flow yield, we can see the same thing. In this case, the higher the chart is, the cheaper the company. And it's at one of the highest points it's been over the past year. We can zoom out to the past 5 years. Salesforce is literally the cheapest it's been over the past 5 years. Much cheaper on a free cash flow basis. So whether you're looking at price to earnings or free cash flow yield, this company continues to have multiple compression. Multiples are coming down. The company's getting cheaper. And this is coming while they're growing margins, earnings, and cash flows. We have the EBITDA going up. We have the free cash flow going up. Even when we look at it adjusted for stock-based comp or the free cash flow per share, it grew 12% year over year. So still very solid free cash flow growth after a super fast year. Salesforce is returning more capital back to the shareholder. You can see the return of capital over time. That's growing over time. We have shares outstanding declining by 1.5% year over year. We have everything moving in the right direction. Even their dividends over time are growing. It'll take one really positive quarter to reignite enthusiasm and to see multiple expansion in this stock. Next up, we have one of the big three cloud companies, Microsoft here. The poster child of the perfect fundamentals, as I've referred to this company many times, and they continue to prove that. This company is about as strong as it gets. But right now, I do not rate this one as a buy. I consider it a hold, one to put on the watch list. I think you'll find better times to buy Microsoft. Either historically speaking or with future assumptions, if we look at the price to earnings ratio, it's about at the high point over the past 5 years. If we look at the free cash flow yield, it's at the low point over the past 5 years. So looking at either earnings or cash flows, Microsoft is expensive. The last time I said Microsoft was a strong buy was at 220. Now it's up to 480. I think there's going to be better times for this one. We can't include a discussion about AI companies without discussing Google. This is a company that fits firmly in the third camp, where it's a company that both creates artificial intelligence and it benefits through its massive applications of artificial intelligence. Now, Google's a little bit different than Amazon. I actually think that Amazon has more ways to benefit from AI than even Google, specifically because of robotics and their huge network. But Google's at no lack of different ways to infuse all their applications with artificial intelligence. They can do it with YouTube. They're already implementing lots of tools with YouTube. They can do it with their entire Google Work suite of products. Google Drive, Google Excel. They're moving in a lot of ways faster than Microsoft in their implementation of AI. Meanwhile, Google's also creating the leading models in AI. In the benchmarks, they test better than OpenAI in a lot of cases. They have hundreds of millions of people now using Gemini. They're infusing Gemini into search. They're making it so people want to search more. They're making Google search more useful. It goes on and on and on. On top of that, Google is also one of the big three cloud players. And this is something that I think is worth mentioning. I think the cloud is enormously valuable. We've seen this growth that's incredibly fast growth, faster than Netflix, faster than YouTube. Cloud has grown at a speed of 30% year over year. People love Google Cloud. They're deploying it. It has the security. It has the artificial intelligence. And while they're doing that, the operating margins of Google Cloud continue to tick upwards, now to 17.8% operating margins. This is going to go up to 30% at a certain point. Doubling of margins with 30% growth is massively accretive for this company. So Google has so many things going for it. At the same time, it trades at a comically low valuation, a 19 forward PE ratio, because people are concerned about the displacement of Google search. The free cash flow yield is 3.5%. Even when you adjust for stock-based comp, it's at 2.4, much higher than Microsoft, much higher than Meta. This company's cheaper than any other big tech company, and it has real growth and application, both in the development of AI and the use of AI. For me, Google remains a buy. A story of a successful investment, a company that finally got its re-rating, is Oracle. This is one that first showed up as a cloud company. They were one of the ones that was late to the party, but they're now a significant cloud company. And they've also transitioned, of course, with cloud to artificial intelligence. And now investors are looking far more positively at this company. Oracle has been a huge success, going up 27% year to date. You see the big spike in stock price. They've done this by transitioning to cloud first and then to artificial intelligence. And the story of Oracle is not over. Larry Ellison, that owns about 40% of Oracle stock, is moving up the ranks of the richest people, now in third place. If Oracle keeps going up, if the market cap continues to grow to $1 trillion, he'll become the richest person in the world. And this company's executing so well. Now, this is one that I consider a hold right now. I think it's one that's interesting to look at, do some research, put it on the watch list. If we do get a dip in this one in the future, it's one that I'm going to be looking at. Now, next up, we have the AI company itself. In many cases, people refer to this as the go-to AI play, which is Palantir. Palantir is up another 3.5% on the day. Investors have reached euphoric levels of bullishness on this stock. The bullishness knows no bounds. It's unabated. It continues on with extreme momentum. Every day, it seems like investors buy more Palantir stock without any real regard to the valuation. It doesn't seem like it's a concern right now. The story with Palantir is that it's so much bigger. It encapsulates something so much grander. It has so many applications and so much growth that you can pay virtually anything right now and you'll still be on top. Now, I don't debate that Palantir is an amazing company. I really think it's a great company. I like Palantir. I like the software. I like the recurring nature of it. I like how much money they make per individual client as well. They have a valuable product, but I just can't get behind the valuation. For me, it's just too much. I know it'll probably go higher. We'll probably see Palantir at 150 or 160. I'm not saying we won't, but for me to put a substantial amount of money in a company, I have to wrap my head around the valuation. It has to make sense to me. Right now, we have Palantir trading at a $323 billion market cap. For reference, Salesforce is $250 billion. So Salesforce is a much smaller company by market cap than Palantir. So investors today buying Palantir continue to bet on rapid, expansive growth of Palantir. That will likely happen, but a lot of that is priced into the stock. So there we have 10 leading AI companies. I believe these are all ones that investors should have on their watch list, they should be looking at, and some of them I believe are obvious buys today. Now moving on, we get to more AI news. We had a recent interview with Brad Gerstner. He went on to CNBC and he had a bit of a speech that he gave. It was like a hoorah for AI, but he made a lot of definitive claims about AI, and I want to go over them. We're going to go through them. I'll respond point by point to some of the bigger definitive statements that he makes.
We're saying, oh, this training is hitting an upper bound and all this AI is overblown. And remember, Nvidia fell and all these AI stocks were falling. And Jensen Huang said on the podcast, he said, we are now moving into inference time reasoning where the machines begin to recursively think for themselves. And he said at that moment, inference isn't going to 10x, it isn't going to 100x, it isn't going to million x, it's going to 1 billion x. Everything in the world is going to be inference. And what has happened this year? Exactly what he said. The token production at Google has gone parabolic. At Amazon, parabolic. Why? Because everybody in the world is using ChatGPT to get answers to their consumer questions. Every single search now on Google is an inference search because they want to give an AI answer. The era of 10 blue links is dead. And now every single person on the planet expects answers. And for enterprises,
Okay, let's pause it there. He says a lot at this first part. First of all, the big thing that Brad Gerstner gets right here that I want to highlight is that he's overall very directionally correct. He has everything put into artificial intelligence, his whole portfolio. Now, there's little minor disagreements of what are the best AI companies from me to Brad. We might debate that, but we have the same type of overarching view that artificial intelligence is here to stay. It's growing massively over time. And of course, Jensen, being the CEO of Nvidia, is going to state that view as well. Now, the billion or million times growth in inference, you can kind of debate the numbers, but either way, we're going to have massive growth in inference. That's something that we know. And it's important to understand these terms like inference. Simply put, you can break up an AI model into two different categories. You have the learning or training part of it, where they train with new data and they just take everything in. And then you have the part where they make judgments, considerations, thoughts based on the available data that they already have. That second part is inference. So when you see them already pull together a bunch of data, and then they're kind of thinking through it, using logic and reviewing what they've done, that is inference. And that's what he's saying is growing substantially. The ability for AI models to not only just pull data from everywhere, but now for them to think and form logical conclusions on that data. And that's a thing that's going up exponentially, going up 10, 20, million, a billion times, according to Jensen. And these are all real things happening. Now, one point that I think is a common point that Brad brings up that I think is a bit of a straw man is he continually says that the era of the 10 blue links or the 10 blue links on Google, that era is dead. It's no more. That's true, but Google really hasn't been a 10 blue link company for a long time. If you search a movie, it's not just going to give you 10 blue links. It's going to give you images of the cast. It's going to give you a breakdown and summary of the show. It'll give you a lot of information about that movie. If you search for a company, it'll give you lots of information about it. If you search an individual like Brad Gerstner, Elon Musk, you search popular people, it'll show you information and photos of them and net worths and profiles. Google has been surfacing real direct answers for years now. Artificial intelligence does it in a more succinct way, and it can answer more complex questions. But Google's also been very quick to give AI overviews and direct answers to implement AI mode. Google search has not been a company where you search in the search box and just get a list of links for a very long time. And this is a straw man argument. It's something that OpenAI investors like Brad Gerstner say to minimize the role that Google has historically played, to minimize the efforts they've done to give direct answers for years now, and the growth in all of their artificial intelligence. So when you hear investors scoff and say that the era of the 10 blue links is over, that's true, but that's been the case for a number of years. We've moved on from the 10 blue links a long time ago. They are firmly put underneath a lot of direct answers. Now, Brad continues on emphasizing the overall growth of AI.
And I will tell you, we are in the first inning. It may be the first batter in the first inning. And so it feels like a lot, But what we're seeing this year, what we're hearing, these moves by the biggest companies on the planet, none of this is surprising. This is the beginning of a massive wave. Oracle reported last night, right? Incredible numbers, accelerating numbers in terms of the data center and compute build out. Jensen Huang said over in Paris this week, he estimates $1.5 trillion of AI compute build out. On the Middle East visit that I was on recently, we're going to build massive Stargate cluster in the UAE. They're going to build in Saudi Arabia.
Everything he said here is correct. And the big point he's emphasizing once again is that you might already think that AI is big, but it's much bigger than what you think. That's the point here. As big as you think AI is, 10x that. 10x your thoughts of the potential growth here. And that should align your investments more firmly towards companies that can either create AI or directly benefit from the application of it. And he continues on emphasizing this point of how right now we're underestimating AI.
Reality is we overestimate in the very short term what these things will do, but we dramatically underestimate in the long term. And that's what I think you see in the market today. You see this acceleration because every one of the smartest players in Silicon Valley, whether you're running Amazon, whether you're running Meta, whether you're running OpenAI, whether you're running Google, they all tell me the same thing. We have to do whatever it takes in order to capture and invest in that future. That's why their CapEx is going parabolic. That is great for the entire AI compute stack, whether you're TSM, whether you're Nvidia, whether you're CoreWeave, where we're investors as well. All of these
or ASML
companies, ARM, et cetera, are going to benefit from that compute build out. And then now we're seeing it in the applications, right? The companies I mentioned, like Snowflake and Databricks, we're seeing it, in the end user applications where we're seeing accelerating growth at places like ChatGPT.
I agree with everything he said so far. We first saw the accelerated growth in revenue for the hardware makers, the ones directly being paid to create AI models. But now we're starting to see it in the software. Now, next he goes on to emphasize the growth of OpenAI. And something you need to know about Brad Gerstner is right now, as far as I can tell, from the latest data that's public, he has a large investment in OpenAI. So he's very bullish, he's aligned with the company, he's an investor directly in OpenAI, and he doesn't own Google stock. So obviously this puts him at odds where his views are very bullish on OpenAI, not quite as bullish on Google.
ChatGPT got to 1 billion searches a day, right? 8 years faster than Google did. This is not internet time. This is AI hyperspeed. It is.
Okay, this big drop the mic phrase that ChatGPT got to 1 billion users 8 years faster than Google. This is something that again is technically true, but is missing a lot of important context. Google was getting to 1 billion users at a time that the internet was in its infancy. Not everybody had smartphones and instant access to applications. They didn't have distribution. The reason that ChatGPT grew so fast and so viral wasn't just because the product itself. There's a lot of credit to be given to ChatGPT. It's a great product, especially when it was released. But the reason it grew so fast was because of distribution. That's because of the internet and the maturity of the internet. App stores, instant access, high speed, cable, Starlink, internet everywhere for everybody. That didn't exist when Google was growing. So Google was at a massive handicap during its growth compared to ChatGPT. Almost every new application that's popular grows much faster because of better improvements in distribution. TikTok, for example, gained users far faster than YouTube or Instagram. That's just because it's newer. Temu, likewise, got downloaded much more than Amazon if you mapped it out at the very beginning. That's because the app stores and the distribution is far more mature. So it's just a bit unfair to compare the growth of OpenAI today with the modern rails of distribution compared to Google 20 years ago, where the internet was barely a thing. It'd be like comparing two different race cars and their speeds when one of them raced on a gravel road and the other raced on a modern racetrack. Obviously, that's a big consideration. But overall, that's a bit beside the point. Brad Gerstner is correct that artificial intelligence is here to stay. It's going to grow exponentially. Some companies will take full advantage of this. Now, moving on, we get to a news story here about Meta. Mark Zuckerberg is doubling down on the AI commitment. This has to do with their latest acquisition they announced. Meta Platforms keeps writing bigger checks to pursue its artificial intelligence strategy, and traders keep cheering it on, encouraged that the expensive bets will keep paying off. Meta finalized a $14.3 billion investment in Scale AI, whose leader is joining a team of being assembled by Chief Executive Officer Mark Zuckerberg to pursue artificial intelligence. That comes just a week after Meta raised its capital spending forecast for 2025 to as much as $72 billion. So Meta's now back firmly in the acquisition buy growth stage. Quote, the amount of spending might give some pause, but we're confident Meta can use AI to drive revenue and accelerate growth. I'm one of the investors that is cheering on this acquisition from Meta. I think that if they can snag up these type of companies and make it so that they have better AI tech, especially AI infrastructure, which Scale AI does, I think that's a really good acquisition. So hopefully for shareholders of Meta, this thing will go through. I think there's a good chance it will. Now, moving on, we get to another AI story. In this case, we have Disney and Universal suing an AI firm over copyright infringement. The movie company sued Midjourney, an AI image generator that has tens of millions of registered users. The 110-page lawsuit, 110 pages, they have a huge law team to work on this, contends that Midjourney, quote, helped itself to countless of copyrighted works to train its software, which allows people to create images and soon videos that blatantly incorporated and copied Disney's and Universal's famous characters. Midjourney is the quintessential copyright-free writer and a bottomless pit of plagiarism. That's directly from Disney. They call them a bottomless pit of plagiarism. The company said in the lawsuit, which was filed in the U.S. District Court of Los Angeles, Midjourney did not respond to requests for comments. The AI startup, like Midjourney, which was introduced in 2022, did train their software with data scraped from the internet and elsewhere, often without compensation for creators. The practice has resulted in lawsuits from authors, artists, record labels, and news organizations, amongst others. Now, there's a lot of debate on this subject of what should be allowed for these AI companies to scrape and consume and what they should have to license. But if we look at some of the images that Midjourney is creating, it's very difficult to defend. This image off to the left was created by Midjourney's AI. It looks identical to Disney's Darth Vader. There's no difference. They're literally using the data, the IP of Disney, and just recreating it in image form. The image off to the left of Elsa is generated by AI. The images on the right are the original thing. It's a carbon copy. It had to be trained on Elsa, otherwise it wouldn't be this perfect. And you see example of this, all their famous characters basically being recreated by artificial intelligence. And that's just an image format. It's now moved to video. Even Google's moved into this with VO3. In fact, there's lots of videos created of stormtroopers doing selfie videos. They are in perfect HD quality. They look exactly like a Star Wars movie. Now, normally with these type of disputes, I don't side with Disney or Universal in that many cases. They're typically sue-happy companies. They're always trying to protect themselves in every way possible. But I think in this case, it is warranted. This should be looked at. They should not be able to take all of their IP that they paid tens of billions of dollars for, that they've developed and that they own, and have AI companies quickly scrape it and then immediately recreate it for free and monetize it. These AI companies are making a lot of money remonetizing Disney's IP. I know a lot of people are very critical of Disney. They'll say that you're a bootlicker or you're defending big companies if you ever agree with them. But in this case, I don't care. I think that Disney and Universal have a point here, and I don't believe these AI companies should be able to generate these images and train on their data without licensing it. It doesn't seem fair to me. So we'll be following this, see how it turns out. But so far, I'm in agreement with Disney and Universal. That's going to be it for this episode. See you in the next one.